Welcome back to the channel. I'm Ozbourne Foreman, and today we're going to be talking about the S&P 500. Now, I know you'll find that surprising if you watch this channel and you are a regular viewer, as I am in fact a stock picker. I have the narrative that I believe I can outperform the markets over the longer term by selecting let's say a smaller handful of stocks that therefore are better positioned over the longer term to generate better returns. Now, I think this is possible because by identifying good quality stocks at a good price, you could effectively mitigate purchasing a lot of the average companies that would be available in a global stock tracker. And therefore, I feel that if you put enough time, energy, effort, and dedicate yourself to learning the stock market, I do think it's possible to outperform the stock market or the benchmarks. That said, I do think this is an incredibly challenging feat to achieve, and I think actually it's going to take a lot of discipline, and so far I've shown that I cannot do this whatsoever. However, the point of my investment strategy and the channel is to show you what my approach is and how have I struggled over time, or what are my successes? Well, at the moment, obviously, I've seen quite a significant downturn in my overall portfolio, and I'm greatly underperforming the overall stock market. Therefore, it can present you more of a balanced picture of what might be the better approach. And so I hope you find today's video interesting, because I think there's going to be a lot of value in this one, because I'm going to merge the idea of the S&P 500 with a stock picking approach, and I think there's value for every investor that watches this video. So if you like this, definitely drop one of these, as it is much appreciated. So starting off, what is the S&P 500 and why is it considered an important benchmark in the stock market? Sorry, some guys just staring me down through the window because you could see that I was recording right then, and it put me off a little bit. So the S&P 500 is the largest 500 companies listed on the New York Stock Exchange. Basically, what this means is the companies, based on their valuation, therefore dictate what position they have in the S&P 500. The largest companies in this New York Stock Exchange therefore represent the largest portion of the S&P 500. As you can imagine, this can become quite overweight in some of the largest companies in the world. Although, when we consider the fact that some of the largest companies in the world have grown to that point and therefore have a merit of success behind them, then we can also say, well, the S&P 500 could be an important benchmark. And typically, a lot of investors, especially those that are looking for more of an active approach, aim to outperform the overall benchmark of the S&P 500. It's a good benchmark because it has a good, consistent average annual return. Now, when we look at the average rate of return for the S&P 500 over the last 20 years, from 2002 to 2022, the annualized average return is about 8.19%. If we almost zoom in a little bit more and we only look at the last 10 years, well, the average rate of return for the S&P 500 since 2012 is 12.84%. Albeit, you need to be quite careful when picking some shorter term horizons, because 2012 would have been the recovery from the great financial crisis, and don't forget that 2020 was a very anomalous year and in which we've seen stock prices rally a significant amount, and the S&P 500 in this regard is still holding up, but a lot of the individual stocks aren't doing so, which presents some of the advantages of the S&P 500. That is that if you don't know which stocks are better or worse, then it provides a very balanced approach. You effectively have diversification into some of the largest companies in the world that are very likely globally diverse. It saves a lot of the stress of having to identify these individual companies that you think are going to do better, and not only identify these good companies, but also find a good price on them. The more of a passive approach, I think, is admirable. It goes, you know what, I don't think I can beat the market. I don't have the time or energy to invest into this and learning how to do so. Therefore, you know what I'm going to do? I'm going to invest passively every single month, dollar cost average, push money into the markets as frequently as I'm paid, invest it in the S&P 500, set and forget it. As I say, this is a very admirable approach, mainly because you don't have to do that much, and you can focus on more meaningful aspects of life that relate to you. Be that if you're training to become a fighter and you want to be the world's greatest MMA champion, well, you can funnel some money into the S&P 500 and you can still dedicate a majority of your time and energy to training and fighting regularly on a basis. Again, that's a very niche idea there, but the point stands. So that is a great advantage. Secondly is typically it's very, very low fee. An S&P 500 index is one of the most, I think, if not the most popular index investment that is available. So therefore, it very much has a very low fee across the board depending on who provides it. I believe I'm with Invesco, and through my free trade SIP, I think I've got a fee of something like 0.06%, which is incredibly low, especially when you consider a lot of index funds typically levy fees of 0.1 or 0.2%, or even if you go into something a bit more managed, it can be upwards of 1 or 2%. So that's quite a low fee, and presenting another advantage. Again, the idea here that you don't have to select individual stocks is a blessing in that regard. And this kind of comes on to the next question. How does investing in the S&P 500 provide diversification benefits compared to individual stock picking? Well, as I say, right, in turn, as an individual stock picker, you've really got to analyze not only a wide range of companies, but identify them in great detail, whether they are worth a greater depth into, right? So the reason the S&P 500 provides diversification here is that as an individual stock picker, you're going to have strengths in industries and perhaps like markets, okay? So I, as a stock picker, might have strengths in hospitality and retail due to my working experience background, right? Alternatively, I might be in the vehicle industry and therefore have a good knowledge of automobiles and business planning. Therefore, I'm going to specialize into that. Well, the S&P 500 does not discriminate in that regard. Sure, it's going to have some sectors that have a higher weighting than others, like technology that's likely going to have a higher weighting. I think it was a 15 or more % when I last checked. You'll have to verify for that for yourself. Of course, this means that if I therefore know what I can select as a stock picker, I'm probably not going to be looking at energy because energy perhaps doesn't make sense to me. I know my own limitations, but this means if an industry suffers a prolonged downturn, for instance in my portfolio when I bought a fast fashion retailer named Boohoo, well, the online retail industry has been struggling following the pandemic. When we talk about the likes of extended delivery times due to logistics concerns, higher freighting costs, higher shipping inbound costs, all of that, outbound as well, it's led to a decrease of the gross margin, coupled with the recovery from the pandemic and a lot of people wanting to go into a physical retail store. This has really put pressure on the likes of, let's say, online retailers. If you're invested in the S&P 500, not only are you getting a slice of some online retailers, but you're also going to be getting a slice of some physical retailers. Now, you're going to have a large chunk of exposure to the likes of Amazon, but you're also going to have a good chunk of exposure to Walmart, to Costco, and it provides great balance, and that diversification is protection against ignorance. If, of course, you believe that you're not going to be able to identify this, and truthfully, you have to be so self-aware to acknowledge this, then the S&P 500 seems like a great approach, especially when we consider the potential risks and drawbacks of investing in individual stocks. Sure, there's potential for a much higher reward, a much greater return over the longer term, because, as I say, with the S&P 500, you're very much locked into the annual average return, which isn't a guarantee, but is likely over a longer time period. The drawbacks and risks of individual stocks is exposure. I could buy an individual stock and go, you know what? Okay, I've looked at the S&P 500 and I've gone and found 10 of what I think the highest quality stocks in this are. Well, if I've not done proper due diligence, which could be likely, who knows, or maybe I've bought a company that's got a bad balance sheet, maybe a limited business moat, meaning it's not very defendable and actually competition is eating its market share. Say, for instance, and I know this is UK listed, but we could be discussing Tesco here. Tesco could seem like a prime opportunity as they are the strongest player in the supermarket market share terms in terms of grocery retailers. However, you could argue, well, Aldi and Lidl are really disrupting this niche and they're gaining market share. This could be a concern. So obviously there's going to be those potential risks and drawbacks in investing in individual stocks, especially when you consider you've got to follow each of these individual stocks individually frequently. So if I've got 20 stocks that I'm invested in, I've now got to keep up to date with all of the news, the directors, the financials, and the annual reports on each of these 20 companies. At least with the S&P 500, I know that there's 500 of the largest companies in the United States that are globally diverse in terms of sales and revenue, that I don't need to follow all of them in great detail because, hey, look, if one performs badly, well, okay, sure, that sucks. And as an individual stock picker, if I pick that one company and I haven't made good risk management, I've got, let's say, 10 or 15 or maybe 20% exposure to this one stock and it's dropped significantly, well, I'm in trouble. However, if I'm invested in the S&P 500, that one stock can drop and it might represent 0.5% of the overall S&P 500, but I'm relatively protected because the rest of the companies in that S&P 500 are doing fairly well or okay, which is where the average really comes into it. The advantage of the average. I believe that using this, identifying the best quality companies in these indexes and then getting a good price on them is prime for being able to outperform the markets. Although, so far, I have not done so. We can even look at my portfolio and you'll see that I have not done very well at all in my ISA. Well, look, I have a value of £22,169. I'm down £18,800 since I began investing, and I think this portfolio started March 2020, which was a prime time to be making some great purchases and acquisitions. And hey, look, I'm still underperforming significantly. Now, this is mainly due to my investment in Boohoo, although I've had some slippy investments in the past. Boohoo has seen a 70% decline in value. Now, if I'd have gone with the approach of investing in the S&P 500, acknowledging that I might not have the ability to identify high quality stocks and shares, knowing that 80% of active, or is it fund managers, underperformed the benchmark being the S&P 500, which has an annual average return of, let's say, 8% per year over the last 20 years, well, I likely could be a lot less stressed and likely in a better financial position by just buying and holding the S&P 500. Although, there's no fun in that, is there? But realistically, if we're arguing about fun here, well, fun shouldn't matter. At the end of the day, this is to generate capital returns on the stuff invested, the money invested. If you're looking for fun, then you shouldn't be investing for fun. That's where you go down to the races and you bet on a greyhound that's clearly been fed sausages that's going to lose the race. Again, I digress here. Point stands. I don't think it's that easy to be a stock picker. I'm aware of that. I choose to challenge the normal. This is why I've decided that I'm going to try and beat the markets. I'm aware that at the moment my abilities have led me to a situation in which I am significantly underperforming. However, I'm not going to give up easily. I think that through great distress is where you are challenged greatly. And with that great challenge, I think some radical changes can be made. And through that tough time, good times can follow. So by really embracing these losses, understanding why this has happened, and really inverting and looking at myself and my own ability, I believe it is possible to outperform the market. Realistically though, I think, and if I'd have gone back in time here, right, in hindsight it's quite easy. If I'd have gone with the approach of the core and satellite strategy, like I've done in my free trade SIP, there's about $3,500 here for reference. I don't really show this too often. And I'd have just gone, okay, I want a majority of my investments in the S&P 500 or a globally diverse stock market tracker. By having this available, I can then spend, 10 or 20% investing in other riskier bets, right? But I know that majority of my portfolio is relatively safer in an S&P 500. At least I know it's diversified amongst 500 companies. And of course, if the S&P 500 is down significantly, then there's going to be some greater overall concerns with the global economy. As they say, when the US sneezes, the whole world catches a cold. So obviously there'd be probably greater concerns to be worrying about if the S&P 500 has, say, declined 70% like Boohoo, one of my holdings in the portfolio. That said, with stock picking, I do think there's more chance for opportunity. It's unlikely an index is going to be dropping greater than 50 or say 60% without rational reasoning, whereas a stock could likely do that. A stock can see extended periods of time where it has not reached a fair valuation. That is where opportunity is granted, in my opinion. And I think that truly is where these stock pickers can really make a return and therefore beat the benchmark. But in order to do that, I think you've really got to play a patient and long game. As a stock picker, you've got to be willing to wait 10 years on an investment, as long as it's fundamentally sound, for it to really pay off over time. And I think that's crucial. A lot of people are trying to get rich quick, but why not get rich slow but effectively over time? Pick the good quality businesses and therefore generate a higher return over the longer term. That said, as I say, if I were to revisit investing and have a more balanced approach, I'd certainly be looking at the S&P 500, having that as the core of my portfolio, and then having 10, 20, maybe 30% at a push, and that's just because I like a little bit of extra risk in my portfolio because I know that I'm driven and motivated to make that money back as hard as possible. Whereas if I was at an older age, I probably definitely wouldn't consider doing that. I would definitely consider the likes of the S&P 500 with its low fees, with therefore its diversification to the 500 most large businesses in the US. I'm talking Apple, Amazon, Google, Microsoft, McDonald's, many businesses, Nike, right? There's so many businesses that are invested. I could have a good share of that. And I know that over time, it's likely that they're going to increase. They're going to make more sales, more profits as these businesses grow over time. Sure, times are tough at the moment. There's high inflation. There's lots of given concerns, and the S&P 500 is at a fairly high price. But if I were to sit there and go, you know what, I'm going to dollar cost average as frequently as I'm paid, put the money into the S&P 500, sit and forget. Focus on other aspects of life. Look at things that matter most to me. Be that martial arts. Be that going out and finding happiness or trying to marry someone because why not, right? The point stands. I think core and satellite is probably a more balanced approach and probably a much wiser idea than the approach I've taken. I don't think anyone should try and replicate what I've done, but I do think by watching these videos, you can learn some valuable lessons through the mistakes I'm making. And who knows, maybe in 5 years' time, let's say 2028 in June, right? My portfolio could be significantly higher. For all I know, Boohoo as an investment might have paid off. Games Workshop, my high exposure to it, may have paid off. Or my portfolio could be radically different and I could be preaching a different approach. The point is that by showing the accountability and transparency, it's available for you to make your own opinion on. And if there is something you'd like to make your own opinion on, I'm writing weekly Stockwatch reports on my Patreon. I'm trying to analyze businesses and really dive deep. This is an 18-page report. They're really detailing insights on competitor analysis, the business model of Diageo, and really what threats Diageo faces. 18 pages. By doing this, I'm hoping that I can learn more about these businesses. Learn more so that therefore I can share more value to you. Now, this is available on my Patreon. It's definitely worth checking out, and I'll leave a link in my description down below. But the most important thing about all of this, at the moment to be discussed about these Stockwatch reports, is that I'm going to be releasing one for free next week. So what I've got is a community poll. So definitely go check out that community poll. And basically, whatever the most popular vote is, I will write a report on this. It'll be about 20 pages, and it'll be published absolutely for free. You can sit there and make your own mind up about how I write these reports, what you think of the quality of it. But what I can tell you for sure is that over time, I'm going to continually improve on this method. And if that is something that interests you, a deep dive on various UK stocks, perhaps ones you're interested in if you make the request, then I think there's some good value there. And at least we can all sort of learn together and therefore perhaps have a greater understanding of the business world, even if it is creating our own business or trying to be individual stock pickers or simply investing in an index fund, but having a greater understanding of what that index fund is invested in on a business by business level. Thank you for watching. Have a fantastic day.